Hello Sector Watchers, welcome to the show. This is the 116th episode of Sector Spotlight for Tuesday the 22nd of February and recording it on Monday the 21st on President's Day. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. Usually I don't talk a lot about how sunny or how rainy or how cold the weather is, but I feel that for this week I just have to mention that we have just broken a record. We now have had 6 days of which are officially labeled as a storm, which means gusting winds, lots of rains, and a lot of damage. And I collected a few clips. I mean, the clips and the images and the videos are flying all over the place on WhatsApp and text and Facebook and what have you. But there's a few that just caught my attention, especially the little black car that was hit by a tree in the streets of Amsterdam, where that big tree just fell on the back of that car, and that it was a lady in the car who was absolutely very, very lucky that the tree only hit the back of her car. And there's obviously the occasional tree in the canal, and as you can see on the images, that pieces of covers are flying around on the highway. These are sound walls, so to prevent sound of the highway to get into the residential areas. But now they're flying around. So a lot of trouble, a lot of wind, a lot of rains, and a big mess in Amsterdam and all of the Netherlands. Anyways, you're up to date now with the weather in the Netherlands and what we've had a bit of havoc. It looks a little bit on what's happening in the markets. We had a week last week. Obviously, we're going to look at that. We're going to take a look at what happened in asset classes and sectors. And as you know, it's the last Tuesday of the month of February. So we're going to look at seasonal patterns for the month of March and what's coming next. See if we can find some meaningful rotations, combine that with the RRGs. And hopefully, it's up to me to make time for that. We're going to look at the international rotations, because usually we look at US markets, and that's all very cool and all very interesting. But with the US stock market now going down, has been going down, and spoiler alert, I think that we're not turning around yet. It makes sense to look abroad and look at other countries and see what's happening there, and if we can find some countries, maybe some ETFs that are worth looking at as a form of diversification when the US market is not doing what we want it to do. Anyway, let's get started with Sector Spotlight, and we're going to start with an overview of asset classes and sectors. With regards to asset classes, we have the RRG for asset classes on a daily scale on the right-hand side, and the weekly RRG is on the right-hand side. On the weekly scale, the rotations are still pretty much the same. GSG and DJP commodities in general are still, well ahead of the rest of the pack. You can see that in the performances here over the last 5 weeks. Over 8%, so they're disconnected from the rest of the performance figures. And also here you can see in on the daily RRG that DJP was leading at 1.3%. GSG was lagging a little bit, lost 0.5. But you can see that on the RRG, they're still way to the right on the positive side of the RRG. Over the last 5 trading days, so last week, literally last week, because today is a bank holiday, you can see that the rotation has reverted to support what's going on the weekly RRGs. You see the cluster of fixed income ETFs, fixed income asset classes, corporate bonds, high yield government bonds, all starting to pick up relative momentum again, while risk on assets like real estate and stocks, SPY in this case, have started to lose relative momentum, and you can see that SPY here is actually shaved off that 100 level and is now on its way down, and it's pointing towards the lagging quadrant, going opposite of those fixed income asset classes. That's now starting to back up the rotations that we see on the weekly RRG, where SPY is rotating into that weakening quadrant. Still not on a very long tail. I think the market still needs some sort of a catalyst for an acceleration lower if we get it. But when that happens, then you will see this tail accelerating towards the lagging quadrant. And very likely you will see an acceleration for those fixed income related asset classes that are now still inside improving. High yields already crossed over into leading. And we still see some strength for the US dollar. We see again strength for the US dollar, I have to say. So that's the story there. Still weakness for stocks, still weakness for risk on assets. Safe havens, government bonds, to a lesser degree, high yield and corporate bonds are doing relatively well. Don't forget that this is all based on a relative basis, or all based on relative strength. That does not mean, and it does not say that those asset classes like government bonds and corporate bonds will be going up in price. At the moment, it means that they are going down less fast than stocks. So that's why they're outperforming. But in the end of the day, they're losing asset classes. The only asset class that is also picking up strength on an absolute basis, on a price basis, is commodities, where you see very long tails moving into that leading quadrant. I've picked up a few individual charts to quickly inspect. Obviously, the S&P 500, it's now very clear that we've left that rising trend channel. We even left that trend channel which was at a little bit slower angle. And we already have had that bounce back. So we put in a new support level. We tested support around 420, bounced back. Old support became resistance. And now we are on our way back to a new test of that support level. So I think that for the S&P 500, that's now the crucial level. It's around 420. If you're going to look at the daily chart, then you see that a small double top was completed around 456, 457. And we also had a bounce, and again, you had old support tested as resistance. Again, here we have old support tested as resistance. And on Friday, we fell below the previous low, which is again a confirmation of this shorter term downtrend. And we're looking for a further decline towards the 420, 425 support area. And you can see, and you will understand, that when we break that area, 420, 425, that's a major area. That's a major level of support. If we break that, it opens up a whole new area of or possibility of lower prices. And you can see here that the relative strength is rolling over slowly. You see the RRG lines rolling over slowly. This is against VBINX. And if we bring in VBINX as the benchmark, and here's the chart of VBINX, you can see that this is also, and obviously this is 60% stocks, 40% bonds, so it's heavily tilted towards the stock market. But still, this is a rolling over market. This is a chart with a bad outlook. We've left that trend channel. We completed a double top. We bounced off support, tested former support as resistance, and now we need a little bit more confirmation, but it definitely looks as if we're breaking below this support level here. And then you're in for a move towards, in this case, 42 or maybe even 40.50 in VBINX, which means that both stocks and bonds are going lower, and that's not a good move for investors, especially not if you're looking at this from a longer term perspective with longer term portfolios. We're going to look at the monthly charts next week again when they're completed for February. I'm sure there'll be a lot of damage done there as well, but the real long-term uptrend is still there. I think this is a more serious correction within the uptrend that we've seen taking place already, since 2020, But if we go even longer, then, you know, let's quickly make this a monthly chart, then you see that this move is underway much longer, and we've had some sort of correction along the way. And, you know, the 2020 correction was the biggest one, but it's already more than 2 years since that correction. And this is one of the things. It's very difficult to call a turnaround or call a correction spot on, because, you know, it's very difficult. But imagine when we do get a decline to, I don't know, let's say that this old peak here, and I'm just, you know, throwing out some thoughts here. If this old peak here around 340 or this one here at 360 is tested in the next couple of months, and then we put in a low and we go higher, and we look at it, let's say a year from now, in February 2023, we'll all say, yeah, that was a good correction, no problem at all. But for now, if you have to do it right now on the right, that's the hard edge of the sides, the hardest part of the chart, the right-hand side, we're looking at downside risk of 360, 40, 70 points, 70, 75 points. That's quite a decline for the S&P 500. So I really do think that the risk reward for investment in stocks at the moment, for new investments in stocks at the moment, is tilted to the downside. So I would not think about putting on new positions in the stock market in general. So have a quick look at corporate bonds. Here also a big decline, strong break of support. But you can see here that on a relative basis against VBINX, or in this case it's against SPY, you can see that they're picking up slightly, they're rolling over, so they're improving versus the S&P 500. And if we do the same for high yield, then you can see that this long-term downtrend is leveling off and starting to pick up, despite the break of important support levels on the price chart. So wrapping this up, risk reward for stocks at the moment, not very favorable. I'd be very careful. And we're going to take a look at the individual sectors in a minute. For sectors, the rotational picture on the right-hand side for the daily RRG and the left-hand side for the weekly. And you can see it's a bit all over the place here. You see, you know, vertical moves are usually like temporary, where one sector picks up relative momentum and the other one drops. That's exactly what we're seeing going on right here. It looks a little bit like what we saw on the asset class RRG. And if you look at the performance of the various sectors, then you can see here that consumer staples, XLP, picked up 1%. The only sector with a positive return last week, and that's offset by energy, which lost 3.4% last week. Obviously, we all know how well energy has been doing over the last couple of weeks, and that shows on the left-hand side where you see the weekly tail for the energy sector, still powering ahead further into the leading quadrant. If you look at the picture of the energy tail on the daily RRG, you can see that we moved from that move out of the leading quadrant into weakening, and now starting to curl back up. So it went through a pause in its relative move, but the longer term tail still pointing in the right direction. And the way I look at it is that the odds are very big that this daily tail will start to rotate further up towards the leading quadrant and join the direction of the weekly tail. So then the weekly and the daily are back in swing and back into the leading quadrant, pushing energy further up into the leading quadrant, which means as an outperforming sector versus the S&P 500. Now, what else do we see here? We see a good tail for consumer staples. Already told you it's up 1. And that matches with what's happening in the weekly RRG for the consumer staple sector. So that's definitely, you know, the way to defense. XLP is a very clear example of that. We see financials on the back of rising interest rates. You see financials doing well, and that's also back in swing, back in sync with the weekly tail that is moving further into the leading quadrant. And you see the rotation for financials on the daily has rotated or completed the rotation from leading through weakening and now back into leading again. So that is a good sign for the financial sector from a relative perspective. What else do we have? If we look at the weaker stuff, you see that the technology sector did not do very well. And you see it here moving almost vertical on the 100 level on the RS ratio scale. It's now moving into the lagging quadrant, and it's starting to confirm or to move in sync with the direction of the tail for the technology sector on the weekly RRG. So that's expected more weakness for the technology sector. And despite the fact that consumer discretionary was relatively a good sector last week, you can see that on Friday we started to roll over. And if we look at the tail for discretionary on the weekly RRG, you see that it's pushing into the lagging quadrant. That little hiccup here is the result of the strength that we've seen, the relative strength that we've seen for discretionary since, when was that? The start of the month, so the last 2 weeks, two and a half weeks. And, you know, it looks as if we're now already starting to roll over. If we're going to look at a quick look at some of the individual charts for these sectors, then I've picked a few, and communication services is one because it definitely broke below support level, important support level here. So that is definitely pushing further into the lagging quadrant, an underperforming sector. If we look at energy, that's the other way around. It's holding up very well above that breakout level. That also goes for relative strength. That's still doing really, really well. You can see that financials are holding up. They're not breaking out to the upside, but they're holding up very well. They're not in a downtrend. Higher highs, higher lows, and look at the relative strength here. That's breaking above that multi-year resistance. So that's holding up very well. Here is industrials. That is at risk. Watch the break below 97.5. Here's technology. We've looked at that chart, double top, topish formation, old support, tested as resistance. Watch 146.5 in the technology ETF and XLK. Consumer staples holding up well. That's the defensive sector that's doing great. And then you can see healthcare, which is another defensive sector, but that's doing not so good. It's holding up, but it's not really the defense that you're looking for. That you get that much more in the consumer staples sector. So here relative strength is moving sideways, and we really don't want to see this fall below that old support level. And then finally, we've got consumer discretionary, top formation completed, old support tested as resistance. Watch for 173 in XLY. If that breaks, we're going to see much, much more downside. It's time to start looking or look at our monthly view on seasonality for next month. As you know, the last Tuesday of the month means seasonality in Sector Spotlight. Question is, do we really need to do it this month? We'll do it very quickly because it is, you know, it's a fixed segment and it keeps the flow going. We're in this rolling procedure where we do it every month, but we can do it really quickly for the month of March, because if you look at the seasonality here, then the whole column of March is very close to 50, 45. This is a high one, 57, 50, 50, 55. And then there's two that are standing out. There's real estate and utilities. And then we've got healthcare and discretionary. Now, you know that we are looking for values over 70, minimum over 70 or 30, maybe 35 and lower. There's none of that on the downside. And these are, the numbers here mean the percentage of months that that the sector outperformed the S&P 500. So they're on a relative basis. This means that for the next month in March, real estate and utilities have shown a high tendency of outperforming the S&P 500. For utilities, with the defense going on, that might be possible. But when you look at the chart of utilities, it's not the best one. And if you look at the chart of real estate, that is definitely not the best one. So I find it hard to believe, given the current rotation, when you look at the RRG, that these sectors, either or not even both, will be able to strongly outperform the S&P 500 in the coming month. My best bet would be for utilities going forward. But if you leave the rigid month-to-month numbers and look at a little bit more, flowing type of movement, and we look ahead, then we can see that already in April, the numbers drop back to 50-50. And in May, real estate could be a little bit higher, but utilities you already see at 40%. So that's not a big, very strong statement or something that we can hold on to. If we look at the accompanying performance numbers in terms of performance versus the S&P 500, then we can see that real estate historically outperformed the S&P with 2.4% in the month of March. Again, with the current rotation on the RRG, I don't think that's going to happen. If you look at utilities, historically it's outperforming the S&P with 1%. So again, here, the utility sector obviously or most likely gives us the best bang for our buck. Although I'm not super convinced, given the rotation on the chart on the RRG is pretty good. But the chart for utilities itself is not that good. So there's a little bit of a conflicting situation there. But gun to my head, I'd say utilities is the best bet for the month of March. If you look at all the others, then there's really not much going on in terms of outperformance, underperformance. Energy, an underperformance of 90 bips, but it's in between a very strong month of February and a very strong month of April. But again, if you look at the percentage of months that it's outperforming, then that's all a 50-50. So, when these are 50-50, then the outperformance numbers, they got a lot less meaning in my opinion. So real estate and utilities are standing out in terms of the percentage of months that they've been outperforming. So the odds seem good. The rotations are not that good. The average performance numbers are really good for both real estate and utilities. Given the current rotations, I would prefer the utility sector in the month of March as one of the stronger ones. But in the last segment of the show, I want to take a look abroad and broaden our horizon and see if we can find anything outside of the US which might even be more interesting to look at. Now, if we broaden our horizon outside of the US to look for investable opportunities, the RRG that's showing you the rotations of world stock market indexes versus the Dow Jones World Index will be, or Dow Jones Global Index it's called, will be helpful. And what you see here is pretty striking, because you see that a lot of these tails are moving to the northeast, which is positive, versus the global index. But also look at where the S&P is. You see that the S&P is rotating into the weakening quadrant and towards lagging, while a lot of the other indexes are moving towards the top right-hand corner. And they're all outperforming the S&P 500. So they're all good opportunities on a relative basis, that is. Now, we can't go over all of them. There's no time for that. But there's one that stood out particularly strong for me, and that's the Indonesian market, the ID Dow, the Indonesian stock market. So that's the Dow Jones Indonesia Stock Index. And if you look at the rotation, we see that that is a typically strong rotation moving back towards the leading quadrant. And when we bring in the charts, then we can see that this market is breaking out of this consolidation, which is forming just below that overhead resistance area that's angling slightly down. when we break that, that unlocks a lot more upside potential. And look at the relative strength versus the global stock market index and as well versus the S&P 500. That's definitely on the rise. That's definitely improving. And if we look at that on a daily scale, you can see that it is gradually moving higher, and you see the break here in relative strength already taking place and the RRG lines moving back up. The investable instrument that comes with this index is EIDO. That's the iShares MSCI Indonesia Index, and you can see that it's following a similar path. The only thing you need to be aware of is that you inherit a currency risk here. This ETF is traded in US dollars, but with the current strength of the US dollars versus the rest of the world versus world currencies, I think that could be an added benefit, so a little bonus from the currency perspective. And this wraps up Sector Spotlight for this week. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope you enjoyed the show, and I'm looking forward to see you again next week, same time, same place, at a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.